Or you could have other people where they're just starting out, they're in their early 20s, they're not really sure if they want to own a home, they just want to build their investments and kind of increase the amount of freedom and flexibility they're able to have in their lives. So they start investing in ETFs, maybe they invest in property, doesn't really matter. And then they want to get to a point where whether they're 28 or 32 or 35, they're able to choose whether they work or not, because maybe they're going to do some travel or they're going to take a few years off and they're going to kind of recalibrate their life and see where things end up later. So I don't think it makes sense for those people to kind of max out their super, because by nature of doing so, they're going to have less money to put into those other areas that are going to actually move the needle for their specific goals that they have in their personal lives.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor.
All right, guys, welcome back to the Aussie Fire podcast. So in the last episode, if you listened to that one, we spoke about some of the financial advice that we see gets mentioned in society quite a bit that we somewhat disagree with. And we kind of unpack the different ways where we think about these topics in a slightly, maybe more nuanced or slightly different way from the norm. So we did a few in that episode, and we've actually got a few more that we're going to cover with you in today's episode. And so there is a couple to cover here, so let's just kick straight into it, mate. And I think you wanted to talk about something to do with investment properties.
Yeah, that's a great way to start, I think. Everyone loves talking about investment properties. I want to add that I think the common advice people get is to invest in property, particularly, through an investment property apartment in cities. Most Australians live in cities, so most young people get pushed into apartments because that's typically what's within their capital range. I don't think this is a universally bad idea. I just think that it's oversubscribed advice, you would say it. Because, investment properties are a totally fine thing. I've talked about this before. Like if you have a property you want to live in, but it's maybe too expensive or too big, an investment property makes sense as a way to kind of, protect yourself against the cost of the mortgage by renting it out until you can move into it. But just generally the idea that like, oh, you're a 21-year-old, you have $50,000 in the bank, you should just go and get an apartment to get into the property market because it's good to do things with your money like that, with no accounting for the capital growth of apartments, the overheads of property, comparing that to ETFs and stuff. It's basically, in my view, it's oversubscribed advice because of the fact that the people giving it to you are typically parents for people under, 40, call it. And two things about parents. Number one is a lot of them went through their own investing journeys before non-property investing was as easy as it is today. And two, a lot of them have made so much money off property, particularly through housing specifically. And when I say made money, I mean they've seen their portfolio increase, that they just assume that that's the way to do it then because they just happen to be part of a very odd boom is one way to think about it. So that's why I think that advice is oversubscribed.
I would agree with you to some extent. I would say it's often coming from a place of wanting security for their children, for their adult children, let's say. So that part of it makes sense. Obviously people associate housing with, I would say, not only the most secure asset class, let's say, but also the most secure way to protect your future, I suppose. So they see, well, if they have something property related that they own, at least that's future optionality for them. And that part of it makes sense. But what I've noticed is that quite a few younger people that follow me that I've spoken to, they don't want to be, they sometimes see the idea of having a mortgage for 30 years or 20 years, whatever. Even if it's an investment property, they still see it as a liability because they know, whether they've read about it or they've heard about it, that they're still going to be on the foot for a lot of different expenses, as you said, Hayden, and they're most likely overwhelmingly going to have to be putting money in their pocket to maintain the costs of owning that investment property for the foreseeable future until the rent eventually slowly catches up to covering all of those costs. And I see more young people now not really wanting that to take on that sort of a liability at a young age. They would rather have the simplicity of investing in ETFs and other things, because as you said, they're much more accessible now in a very diversified and low cost way. So I do see that increasing in popularity. And I think that makes quite a bit of sense, to the point where, yes, you can still invest and put money away for your future and get somewhere financially, while also not being beholden to this, large pile of debt and these ongoing repayments and all that, and the admin of owning an investment property as well. So I do think it probably is oversubscribed, as you put it, and that there are, other avenues that are equally healthy for your long-term wealth in terms of putting money into and creating financial security in other ways. Because I think people tend to equate security only with housing, but you can be equally as secure with a massive share portfolio as well. I don't think a wealthy share investor who doesn't own a home, I don't think they're too stressed, because I'm sure they can afford their rent quite fine.
I think whilst we're on the topic of housing, Dave, it's worth talking about another one of the pieces of financial advice that I would consider to be maybe not something I agree with, which is the idea that everything you do is about eventually buying a house. And when I say house, I mean like a detached dwelling. So if you're buying an apartment, it's so you can eventually sell that to buy a house. If you're not buying an apartment, it's so that you're investing in ETFs so that you can eventually buy a house. Renting a house is a bad idea. Renting an apartment is a bad idea. Owning an apartment is a bad idea. It's all about getting that detached dwelling. The reason I think it's a bad piece of advice, it's kind of twofold. One is that there's nothing to say that a house is like specifically valuable, like it's all kind of made up. Dave and I were actually talking before we did this episode just casually, and I was giving the example about, my grandfather owns a house, which I don't know is the square meterage. It's somewhere between 500 and 1,000, I think. And it's like, I joked with him to say his father would be so disappointed in him if he saw that he only had this much land because he doesn't have room to grow herbs and tomatoes and chickens and cattle or something like this, right? Like his father was born in obviously like 1900 or something. He's long gone now. But it's like that, but no one around Australia would sit around right now being like, I haven't made it if I don't have cattle. And I think it's just like to understand that, the schema of how we value our living situation is just going to change and evolve over time and adapt to different circumstances. There's nothing baked into the universe about it. That's part one. But part two is also the fact, and Dave and I were also talking about this, it's also just a really cheap time to rent a house, to be perfectly honest. Like with the cost of owning a home, like you take a house in Sydney, like a $2 million house in Sydney or a $1 million house in Sydney, whatever you will, it's like, that's a big mortgage. It's a big step up mortgage. Whereas like, because rental yields on houses are so small, you can actually save like tens of thousands of dollars a year in some cases renting a house instead of living in a house. And obviously no one loves renting. And we've talked about this in the last few episodes, but you think about saving $50,000, $60,000 a year, you only need to take a sliver of that to pay someone on Facebook Marketplace to come pack up your stuff and then pay removalists to move it in the worst case where you have to move every 2 years. And that's not to say that that's an ideal state of living. That's not what I'm aiming for naturally, but it's more like, I think the advice around everything's about a house is very dogmatic and doesn't take into account the nuance that renting a house is a very valid option for a lot of people. And also just never owning a house or renting a house and in some kind of apartment living is also a very reasonable option, contrary to popular advice. I'm not sure if you have any other views on that, Dave.
Yeah, it's quite interesting you say that. So the first thing that came to mind is when you're talking about the no cattle thing, I thought of this concept of like big house, no cattle, right? Because no one wants to have, they want a big house, but no land behind the house, just to, so big house, no cattle. And then just to add on to your renting thing, it's quite interesting when you look at the property market broadly, where houses themselves have lower yields than apartments do. So if you're picking between them, houses are then cheaper relative to the cost of owning that particular property compared to apartments because of the gap between the yield and the mortgage cost plus the ongoing ownership costs. And then also as you scale up the level of prices or values in the housing market, it becomes even cheaper again is by a function of the yield going down, so that you get to the point where you have $2, $3, $4 million homes, and the yield doesn't become like, it goes from being like maybe 4% for a unit to 3% for a house. And then as the price escalates upwards, it then goes down to 2%, 2.5%, and under as well as the price kind of scales up. So it's very, very interesting. It's almost like, I mean, there's pushback when you say that, you know, it's cheap to rent, right? Because obviously people see rents going up, and obviously there's a knee-jerk reaction where it's disgusting to say that rents are cheap, right? But you're comparing it to the cost of owning. Everything is relative to something else. So it's interesting that you point that out. And when you have people that argue that, okay, renting, if they're trying to argue that renting is expensive, well, then you obviously can't afford to own, because owning is a lot more expensive than renting. So then that's like a nonsensical argument, right?
A question I've been putting to a lot of people recently, Dave, has been, I'm not saying that renting forever is a good idea. It's just that the Australian tax system and welfare system basically strongly incentivizes you to own the place you live in when you're on the pension, if you're on the pension, right? So let's imagine you're going to be on the pension when you're 70. Where do you want to live when you're 70? Do you want to live in a big house with all this stuff to maintain? I would say my guess is that, particularly in cities, a large number of Australians, particularly young Australians, would be happy to eventually, once their kids have moved out of home, live in an apartment eventually. You know, something small, maybe something ground level, something easy to maintain, but not too small, but spacious enough. So what you really are then saying to yourself is like, well, I want to be in the housing market in some way so that, you know, I could hedge against that if you're the kind of anxious type. But you don't necessarily need a house forever. Because the main advantage of if you do intend to live in a house forever, obviously you don't want to be renting it, you know, when you're 70, 80 years old, not only for the security element of it, but also just like the pension benefits of it. But if your plan is probably to sell that house and move into an apartment anyway, the benefits, I think, start to disappear. And just to give some maths to this example, I'm looking at a random house just a few streets away from me that I looked up online. Its estimated value is 2.2 million. Now, at 2.2 million, at a 20% deposit, you are going to have to put in about $450,000 of cash to deposit it, not to mention the stamp duty, which I don't know what that'll be, maybe 100 grand.
Yeah, oof, yeah.
So now it's like 550, and then the interest, just the interest on the loan for the rest of that is $95,000 a year. That same place right now is estimated to rent out at $1,000 a week, or $52,000 a year. And again, I'm not saying that like everyone's going to want to jump to rent it, because, you know, that's not the starting point that I, like all other brainwashed Australians, have. But it's just like, you can't escape the fact that that's like $40,000 a year less in outlay. And I haven't even gotten into rates, you know, and water and whatever else, and other kinds of, you know, annoying maintenance. And that's excluding the fact that that's a whole bunch of capital. That was like $500,000 of capital that gets locked up. That could otherwise be, you know, spent on other things. So it's just a very interesting topic, and something I've been exploring more recently and ranting to Dave about. But that just kind of paints an example about like, don't underestimate renting a house, because the mathematics of it are very interesting. Doesn't mean you should, but people don't often like to give that advice, do they?
No, they definitely don't. So it almost sounds like the cost is around about, well, it's more than double, right? And it could also be approaching triple the cost you'd have to factor in opportunity cost on your 20% deposit, right? Because that could be parked elsewhere and making money too. So there's also that part of it to consider too. So I actually sold an investment property probably about 8 years ago now, and it was in Melbourne, and it was a semi-detached dwelling or house that had gone up quite a bit in value that we'd owned for a few years. And the interesting part about that was when we bought it, the yield wasn't great, but when we sold it, the yield was woeful, to the point where I calculated the cost, and we sold it to some first home buyers, interestingly enough. And I calculated the cost, and when we sold it, the property was rented to a similar young couple. I think it was roughly $470 per week, something like that. And so the property sold for, I think it was roughly $1 million. And when I equated the mortgage and the other ongoing expenses that we were covering, they were basically going to be paying I think it was like 72 grand a year or 75 grand a year, somewhere in that region, 70, 75 grand a year, which was basically triple the cost of renting the property. And I'm thinking, holy shit, I can't imagine wanting to own a home so bad. Because I've never been, I suppose I'm a little bit detached to the housing market, a bit like you, Hayden, where you're like, you look at things and then you be like, I don't feel, insanely strongly that I have to do something regardless of the numbers. Let me look at the numbers because I also have these other goals like financial independence and not overextending myself and having free time, So I've always kind of questioned the numbers. And so I can't imagine ever being in a position where if I'm young and I'm still working and all that, and I'm trying to save and I'm trying to get somewhere and build investments, that I would be happy to spend triple the amount to rent the exact same property just to own it myself rather than to rent it and pay rent to somebody else. That just seems I can't fathom it. I just can't imagine doing that.
Yeah, 100%. My whole thing with this stuff is overextending yourself into a house kind of makes sense if you intend to retire there, because you at least want your, a lot of your capital to be exempt from asset tests and CGT and all this kind of stuff, sure. But, I have a lot of friends who, like, their parents are turning 60, 65 and they're downsizing. They don't want to live in a house anymore. If that's you, think about it deeply. If it's not you, if you're like houses forever, then I think this has a lot less relevance to you, particularly if you're not intending to be a self-funded retiree, which frankly, most Australians don't plan to be a self-funded retiree. In my experience, many of them want to be on the part pension if they can, because people seem to love free money. Who would have thought?
Yes.
But yeah, otherwise, just give it a think. Do the numbers. I'm not saying it's not what I'm aiming for. It's not what my aspirations are in life, but it's definitely something that I don't consider to be a failure. It's just a different option that is probably just a different kind of benefit and different kind of cost.
And I think that's probably a running theme in a lot of the discussions that we're having around these topics. It's not that we're saying you should do X instead of Y. It's that we're saying most people do X, but here's what Y looks like and here's why it might work in certain situations, and just try and give you a more broad of a framework to kind of think about these things so you can pick and choose and decide which things you agree with and which things you don't agree with. And you might be disagreeing with a lot of what we're saying, and that's perfectly fine. But the idea is just like a broad discussion and not just taking this kind of dogmatic approach and questioning things and deciding for yourself what makes the most sense for your particular situation. But while we're on the housing topic, I thought maybe we could also talk about one that I wrote down, and that is the advice of paying off your mortgage as fast as possible. So basically the idea is any extra cash you have, you should pretty much pay off your mortgage. That's the most sensible thing to do. And you should do that before you invest and before you do these other things, because that's your bread and butter security, right? Kind of circling back to the point that I mentioned before. But I mean, I'm not the biggest fan of this. It can make a lot of sense depending on your time frame. And we're speaking to like a FIRE audience here, right? So a lot of times people are wanting to get to a point where they do have a paid off home, and that enables them to kind of semi-retire and have a much lower level of lifestyle expenses and personal costs to kind of keep up with. And that means they don't need as much investments, and that makes it easier to do so. But I also think there's quite an opportunity cost to not investing while you also have a mortgage, right? Because if you flesh these things out over multiple decades and you assume that investments after tax will outperform the average interest rate on a mortgage, which is a fairly sensible argument to make, especially on average over time, that can add up to like hundreds of thousands of dollars, like not small money at all. So I think that that's probably overemphasized, and I would encourage people to consider whether they need to pay off their home immediately as soon as possible. In some cases that will make sense, but in other cases it won't.
I agree. Yeah. I mean, if your aim right now is to, I don't know, I feel like if you plan to live there forever, I get paying it off to some extent because you want that part of your life to be locked down. But if your plan's to sell it, that is where I just personally get a little more confused about the thinking, because there's not this big, broad existential security that comes from it, like it's my final piece of jigsaw and I'm going to live there forever. But regardless of all of that, I think what's interesting, right, is you think about investing in ETFs. If you don't put money into if you have $1,000 in ETFs and you have $200 extra and you choose not to put that $200 in, you're missing out on the growth, of the money you didn't put in. What I find so interesting about housing as a concept, it's not that profound, is if you don't pay down your mortgage or you do pay down your mortgage, your ability to capitalize on your assets growth is the same.
Yes.
You know, whether you paid off 20% or 100%, it's like if the house doubles, it's all that growth is yours. It's not the bank's. It's not like the bank says, well, you only paid off 20% of it, so I'm going to keep a lot of the growth. Like your deal with the bank is basically you get all the upside and you basically just have to pay them a little fee for keeping that upside. So the thing that actually first got me so interested about investing money instead of it being an offset was once I realized, holy crap, I actually get to have two investments. It made me feel so cool. Because I was like, I get to invest in the property market and in the listed equities market, and the bank's just going to send me a bill every month. That's it. That's how I thought about it. And some people have this idea of like, that you have a choice between your capital being in housing or ETFs. But the reality is if you bought a house, your capital's in housing, you're going to get all of the growth. So the real question you're asking yourself is, I'm already in the housing market with that capital. Do I also want to put my capital somewhere else and just get a bigger bill every month? And the cool thing about that bill is it's super predictable. Even though obviously capital growth's all over the place, it's not about taking bets. Like it's not about which bet do you want to take. It's like, do you want to take extra bets for a fee? And I think that's a much more interesting conversation because I feel like the mentality when people put money into offset is that they're shoring up. I'm not saying everyone thinks this, and I don't think people would describe it like this, but I think there is an emotional element there of like money in offset or paying down the loan is like shoring up your investment. And it's like, it's not shoring up your investment. Your investment's your investment. It's just reducing your monthly costs. Is how I kind of think about it. I don't know if that's oversimplified for you, Dave.
No, I think that's a pretty interesting way to frame it. I had a few thoughts on that actually. When you said when you've got like $1,000, say, and you put it in your mortgage versus ETFs, you're not putting $1,000 into your property. That makes perfect sense because what you're really doing is when you go to the bank and you get a loan for $600,000. And you buy the property, that's when you're literally on that single day, you're investing $600,000 into the property market. You're not investing $100,000 or $50,000 or whatever your deposit was. You're literally investing $600,000 or $700,000 of tangible money into the property market. It's just that was borrowed money, which is fine. So you should think about it that way. And then the extra cash, as Hayden said, then you can decide what to do with it. Whether you put it into your mortgage to reduce your debt or whether you put it into ETFs to try and get more growth. But a couple of different ways to approach that is I had this manager at work and I was talking to him about investing or paying down his mortgage. And he said, I just want to pay down my mortgage because it increases my equity. Like he's framing it as if he's making more money. But I said, you're basically just moving money from one account into another account. You're not like making more money. He's like, yeah, but it increases the amount of equity in my property. And then when I sell it, I get more money. I was like, but it's the same money. It's your money. You're just going to get it back later.
Yeah, like you could imagine it as if the bank charged a 0% interest rate, it'd be no different to just keeping that money in a savings account. You know, like it is just fee reduction. It is just that interest reduction. Because yeah, I mean, the alternative to getting more equity in your home was to have that exact same dollar amount sitting in a savings account and like just not having to pay the bank that monthly bill, basically.
Yeah, exactly. And I think another way I like to think about this is even if you're a homeowner, you can still look at your home ownership and you can approach your property journey from the mindset of a property investor, let's say. So it's not just about owning the home and living in the home and whatever. You could think of it like an investor where you just essentially want to control assets. So like what you said before, Hayden, where you were excited because you're like, wait, I get to own this property and get the benefits of the growth from the property and get the benefits of living in it. That's one thing. But I also get to invest in shares because I can get to keep my money at the same time, right? And invest in shares. So I get the growth of both assets. So I think if you can look at your property ownership from that perspective, it can be useful where you're just basically wanting to control assets. Like property investors just want to control as many assets as possible. They might have, like what I did was I used relatively small deposit to buy more property. So I'd rather buy 2 properties using a small deposit instead of 1 property with a bigger deposit because I could afford that with my income that I was making. So I thought, well, that makes more sense because then I get the growth on more assets, even though I've got less equity in each property to start with. I should get more equity growth over time. That's the idea. So you can kind of think about your home ownership in the same way. And when you do it like that, you also then you think, okay, well, if I'm getting the benefits of living in the property and I'm getting the benefits of the growth of the property, then do I really need to pay it off? And do I really need to pay it off not only as quickly as possible, but do I really need to pay it off at all? What if I had a very slow trickle approach to my mortgage where I just let it pay off automatically over 30 years as per like the standard approach? Or what if I take a slightly more unusual approach and have an interest-only mortgage? Because that will greatly reduce my monthly outgoings, and then I'm able to invest even more money each month. So then I think that's another interesting way to look at it.
I mean, interest-only, mortgages for places you live in are scary to people, and I get that. I think, another way I think about how Dave thinks about this stuff is we all have to accept that we never really are in control. Like, even if you pay off your house, the government can still just be like, we want to build a train station there and force you to sell it. Like, the council can come in and be mad about the length of your lawn, or, if the fence is the wrong height, or you still have to go and ask people to put a pool in or to put another, the world is extremely constrained, and it's very romantic, and I empathize with it because I would love that too, to just be like, I've done my hard work, leave me the F alone.
Yeah.
No more games, no more bank, no more government, just be done with it. No more rates, no more water. But the world always has outlays. You're going to have to pay electricity forever. You're going to have to pay rates forever. And then it's like, well, why don't you care about the electricity? Why don't you care about the rates? Why don't you care about the water? Oh, because you built up a portfolio of some kind, whether it's property or liquid portfolio, that provides you enough capital to cover your outlays. Oh, so what Dave's talking about is just maybe we just have more outlays and a bigger portfolio. It's all just about the size of those two things. So I think it can be really easy to demonize having a mortgage remaining, but you're going to pay stuff monthly for the rest of your life, and there's no escaping that, sadly.
Yeah, there's obviously a lot of practicalities around this sort of thing. Like, you might want to, if you take an interest-only approach and then you stop working, you might not be able to renew the interest-only loan and all. There's tons of nuances that we can get into, but I think the overarching point is quite interesting, where if you just think about it as controlling assets, and you buy the property for whatever, $700,000, and you've got a mortgage on it, and maybe the interest is costing you, let's say, $35,000, $40,000 a year. In 10 years, that $35,000, $40,000 a year is going to feel a lot cheaper to you than it does today, even if the repayment is exactly the same, and even if the debt is exactly the same, because you haven't paid off a cent of it, just due to the nature of inflation, and your investment portfolio would have grown because you've been putting your extra money in there, and you can use that income to help with the repayments, or your natural income from your job has grown, so it's going to naturally feel cheaper. And then in 20 years, it's going to be even more again. So you get to this point, you can imagine over 20, 30, 40 years where the price of your home has gone up in value considerably just due to compounding. The mortgage has stayed the same at $700,000 or whatever. Maybe your home is worth multiple million at that point. And so you might have started with a very high leverage loan, but then in 30 years, it's tiny. It's maybe 20% leveraged or something, but you haven't paid off a cent of the debt, and you've been able to invest in your share portfolio all along the way. And so you get to this position where you've got massive equity, but you haven't paid off any of the home, just by sheer nature of even slow and steady compounding growth over time. So not that that'll work in all cases because of the practicalities and whatever, but just to kind of get this framework into your mind of how to think about things a little bit differently, because there are times when that might be more suitable for certain people.
That makes a lot of sense.
All right, so the next piece of financial advice that I thought might be worth discussing, Hayden, and which I don't think is suitable under all circumstances, but gets pushed a lot, is the idea of having a widely diversified portfolio across multiple or all asset classes, let's say. So the idea is that you should basically just spread your money around lots of different baskets, and that'll give you a lot of different protections, whether it's reducing concentration risk, which is valid, being in one asset class or maybe two asset classes. And you can also kind of smooth out your returns a little bit, because some assets will go up when other assets are kind of languishing a bit. So that sort of makes sense. And you should spread it around, whether it's commercial property and shares and residential property and bonds and gold or crypto and like all these sorts of things. You basically park your money in unlimited different areas and tons of different ways. But I don't find that to be completely appealing for a large majority of the population for a few reasons. And I think that the idea of diversification itself is very valid and it's very sensible and it makes sense in a lot of cases. But I think that you can go too far with it. I think that with a lot of these things, the idea itself is fine, but when people take it to sort of its logical extreme, it gets to the point where it dilutes itself and it doesn't make sense because you might have other plans, right? So the goal of putting money in 7 different asset classes is less than appealing to me for a few reasons. And one of them is the sheer complexity that comes with having your money across so many different things. It's just way more to think about. There's more portfolio admin. You're going to be taking on debt if it's for property or commercial property. You've got a lot more decisions to make because you're like, okay, well, this asset class is doing this, but this other one's doing this. Maybe I rebalance them, but maybe I can't get the percentage I want because then I have to take on debt to buy this property, and then it's going to massively increase my allocation, so I can't really do it smoothly. And then you get to the point where it's not even necessary. Like, it's great you can own all these different asset classes, but you really don't need to for your long-term goals, especially if you're aiming to build like a FI portfolio where you just basically live off the passive income. You don't really have to do much, right? So it's a lot simpler that way. And it doesn't even have to be shares, right? You can achieve your goals with basically any asset class you want. So you don't need to own a ton of different asset classes. You can do it with 1 asset class or 3 asset classes. But I think that trying to spread your money across too many different areas can dilute what you're trying to do. And a lot of times when you are adding too many different asset classes to your portfolio, you are inevitably going to be adding asset classes that are lower than ideal long-term performers. So if you add more, like we said before, if in the other episode, if you're adding bonds to your portfolio, it will reduce your kind of risk and volatility, but it will also, on average, reduce your returns. So I don't like the idea of diversification just for the sake of itself. I think it makes more sense to invest in a very goal-specific way for your circumstances, and you can do that with 1 asset class or 2 or 3. But I don't like the sort of dogmatic approach of you need to do a little bit of everything. I don't really think that makes sense if you know what you're doing and you know why you're investing in exactly what you're investing in and the purpose that it has. So I don't know if you see it any differently, mate, because I don't think we've actually talked about this in terms of building a portfolio with different...
Yeah, I mean, I think you're right. I mean, I think I'd probably even simpler say, like, you got to remember that a lot of ETFs, which a lot of this community invest in, just do that already. You know, so it's not even that Dave's being like, you know, diversification is overrated. It's also just like, it's already present. You don't need to then overcomplicate it. Like, you just take things like VDHG. It's like VDHG, I'm pretty sure that it really has a bonds component in it. And it's basically just betting on the global economy. And you find this a lot with a lot of these big ETFs, is like, they just generally move up and down with the world, you know, like, and it's not to say that like every single investing class goes up and down with the world, but it's like, it's not like during COVID when everything was crashing, someone was out there being like, oh man, that 4% I had in gold is just like holding it all up. It's like, you know, yeah, it's so, I think a lot of products out there are very well diversified already. And it's important to be diversified, but the active steps you have to take to be diversified, it's not 1990 anymore. You know, VDHG, as an example, that's just one example. I don't invest in it myself, but that's only been around like less than 10 years, right, Dave? It's like 5-ish years old, if that. I'm not even sure.
Yeah, the managed fund version's been around longer, but the ETF's it's newer, yeah.
Yeah, so it's like, you know, you might hear someone talk about, you know, diversifying, but some of these things in terms of ETFs and easily accessible, you know, listed assets are just pretty new. So yeah, I generally agree with just how easy it is to diversify without having to overcomplicate things these days.
The main pushback to that you'll hear is that the whole thing is going to go down in a market crash. Like the property that
the
you
ETF
own,
bubble.
No, yeah, well, No, I mean, like, you can have all of these different listed investments, but when you have a crash, all of the listed investments will go down because they're all affected by the same kind of ongoing or negative environment in that aspect. But you can have...
Is that just because they're priced though?
Yes, partly. That's true. That's true. But if you can imagine that if you're reliant on like a portfolio and you're able to have different things that move, that like a zigzag effect, right? Where one asset will zig while another one zags. You might have a case where bonds go up where stocks go down, although that doesn't always happen, or crypto goes up when stocks go down. This kind of thing, and that's the appeal usually behind a diversified portfolio, is it dampens that effect because you've got different performing investments during the same environment, and then you're also less susceptible to those downturns if you're living off the portfolio, let's say. So I get the idea in theory, and you are very highly diversified, but you're very highly diversified within the kind of listed equities space, let's say. Even if there's commodities in there, even if there's real estate in there, even if there's bonds in there in VDHG or something like that. So that would be the natural pushback to that. But yeah, I would say it's best to, if you're going to diversify, do it with ideally high performing long-term asset classes if you can, rather than just adding stuff for the zigzag effect. I'm not the biggest fan of that kind of approach. And make sure you do it where it makes sense with your approach and your time frame, because you can have, or your personal goals, right? You can have a portfolio and you can have money in all these different places, but it doesn't necessarily generate the outcome you want. You often need to have a more focused approach to get the exact outcome you want. I wrote an article about this on the blog a few years ago called Focus, Diversification and Early Retirement, where I had this example where someone had this sort of spray and pray approach, right? They had a couple of investment properties, they had some shares, they had some cash, they had some gold, they had some speculative stocks, they had some crypto. So all of these things will move at different paces and move at different times. So it will give them that sort of a benefit. And then they also had a chunk where they paid off extra on their home because that has its own sort of benefit. And so that sounds great in theory, and it's actually smart in theory. But then when it comes to the time that they want to actually live off this portfolio and be financially independent, the way it's structured is less than ideal. Whereas if they actually take money out of a few of these different things and put it, whether it's in their share portfolio or whether it's removing their mortgage completely, they're actually able to take the same amount of wealth and park it in different places and actually be in a position where they can basically completely retire, rather than just having some here, some here, some here, some here, because some of them were negative income producing, whether it was the properties, or some of them paid no income if it was the speculative stocks or the crypto and things like that. And then some of it did pay income. But if you concentrate into things that are really going to move the needle and get you to the exact position that you want to be in 5 or 10 years, I think that makes a lot more sense. And ideally you can do that while having some diversification. You won't have maximum diversification, but you'll still have some benefits of diversification. And then also building into your plan wiggle room or adaptability around when those asset classes that you are invested in don't go according to plan, because you do need to account for that as well. So it's a balanced approach, right? It's not just like, just throw it all in this one area and you'll be fine. It's not like that at all.
Yeah, I don't think I have much more to add on that one. I think you've summarized it pretty well. And I have actually read that one that you wrote, and people should go check that out too. I'm sure we'll put a link to it in the show notes.
Oh, you've read it?
Yes.
Interesting.
I do read your stuff occasionally, Dave.
That's interesting.
So the very last one that we're going to go through today is one that Dave actually added to the notes, which is that the financial advice that Dave disagrees with is that you should always max out your super, in particular your, concessional contributions and things like that. It's an interesting topic because we've talked about super and super contributions for a while. I don't know if I feel as strongly about Dave on this front. So I probably just mostly want to ask first, Dave, what's the reason that you feel like it's maybe not the most sound financial advice to always max out your super contributions?
Yeah, it's good financial advice, and my opinions on super seem to be heavily misunderstood. Some people think that I hate super for, seemingly no apparent reason, but that's not true whatsoever. I simply push back against the idea that it's because there's free money involved in terms of a tax benefit that you should always, kind of max that out first, regardless of what else you're trying to do. And I kind of understand the point, but I disagree with it, because in practice and for all, practical purposes, you are most likely going to have other goals in life. And this is a FIRE crowd, right? So there are going to be some people in this audience who are in their 40s and they don't plan to retire until they're maybe 50, maybe late 40s, early 50s. And so super is probably going to be a big part of their strategy because they only need enough money to last them 10 years until they can get to their super access age and switch on that income stream. So it's going to make a lot of sense. And they've probably already accumulated a bunch of super up until this point. So it's going to be naturally a good part of their strategy. So that makes perfect sense. But there's also going to be people that are in this audience who right now they may be 20, they may be 24, and they're hoping to either retire or semi-retire before the age of 40. And so for those people, super makes a lot less sense because some of those people are either going to be wanting to either pay off their home as fast as possible, kind of like we were speaking about earlier, where it does actually make sense for their situation. They're going to want to pay off that home and then they're going to have a lower cost of living because they're removing a big debt from their life. And from that point, they can semi-retire, maybe in their mid-30s, maybe by the age of 40. And so they're able to kind of work part-time from that point on. Maybe they've got a bit of investments, they've got their house paid off, and they've got super kind of chugging along in the background, and that'll kind of top them up later, and it will replace their work income that they're planning to do part-time for the next like 20 years during that period of time. Or you could have other people where they're just starting out, they're in the early 20s, they're not really sure if they want to own a home, they just want to build their investments and kind of increase the amount of freedom and flexibility they're able to have in their lives. So they start investing in ETFs, maybe they invest in property, doesn't really matter. And then they want to get to a point where whether they're 28 or 32 or 35, they're able to choose whether they work or not because they're going to do some travel or they're going to take a few years off, and they're going to kind of recalibrate their life and see where things end up later. So I don't think it makes sense for those people to kind of max out their super because by nature of doing so, they're going to have less money to put into those other areas that are going to actually move the needle for their specific goals that they have in their personal life. So obviously I'm biased because that's what I chose. If I was going to max out my super, it would have taken me years longer to retire and leave work, which I did before 30. That wouldn't be possible because I still need a ton of money before I get to like the age of 60, right? Because the amount you need to live on between the date you want to leave work or reduce work to the date that when you can access super, the longer that is, the more you need, especially when you scale down the amount of work you want to do. Yeah, so that's just how I think about it in general. In some cases, it makes a lot of sense. Like if you have a long time horizon, you're just following like a general wealth building approach, you're not super keen on retiring early, whatever, maxing out super makes perfect sense. Like it's awesome. That's what you should do. And then you can invest the money you have after that. But if you have specific goals in mind, may not necessarily be the best approach.
I agree. I probably think there's more scenarios where it's good to do than you, but I agree with you that it can be something that's very bad to be dogmatic. I have a simple view on it, which is particularly if you're on a high income, like above $130,000, $140,000 a year, the tax benefit that you get from using the concessional contributions is pretty material. Like it essentially is like a return on investment of a good chunk of money. Now, if you kind of think about it logically, for a lot of people, by the time they reach the super age, having a lot of their capital, liquid capital in super can be a good thing because of the tax benefits. Okay. So you know that you're going to want a lot of money there later. What's the downside of contributing? The main downside of contributing, in my view, is that you get to the age of 40 and you realize you have too much money in super and not enough money outside of super. And suddenly you're like, all that benefit that I got in terms of extra capital across my overall net wealth doesn't mean a lot to me because I kind of want the capital now, not later. So I look at it as like the super contributions or maxing them out are a good thing, so much as you have a very high confidence that you're not going to miss the money that you put in there before you're 60. And I think the easiest way to do that is to roughly estimate how much on your current trajectory. Like let's just, I've not thought about this at all, but let's just say I'd like to work really hard and I'd like to have $2 million in my super. So I think, okay, $2 million. I'm 30 right now and I have about 200 and how much? It's like 200,000 or something like that in super. So I'm just going to ask ChatGPT right now. I have 200K in super. I contribute, let's call it like 15, or sorry, like 20K a year, something like that. And I'm 30 and it compounds at We'll do 5% annually to account for inflation. It compounds at 5% annually. How many years will it take to hit 2 million? Right. So this is just assuming I'm employed for the next whatever years, for the next however many years. And it's, it's spitting out a number and it's going to come back with a figure. And it's basically going to say it takes about 28.4 years to reach 2 million. And it's like, okay, well, that's really interesting. But then I think I don't want to work till I'm 60. Maybe I only want to work till I'm 45. And then I could say, well, what balance will it be after 30 years, assuming I'm only contributing for 15 of those years? The next 15. Now, I'm just doing this in real time to kind of give you a sense of like how you could just sit down with these tools and do it. And it's going to give me a whole bunch of crap here now. And it's essentially figuring out, okay, there's 15 years where you're contributing, and then there's 15 years where you're just compounding. So let's assume you're planning to quote unquote stop working at 45. And it's telling me that it will get to about 1.76 million after 30 years. Right. Now, I'd have to look at that for a few minutes to make sure that it hasn't done anything silly. But let's just assume that number's right? Because there'd be a whole bunch of scenarios. I would go and say, hey, 1.7 million is pretty close to 2. So it doesn't make sense to put more money into super because it's clear that I might end up having too much in super. What if I get a pay rise? What if I end up wanting to work for 20 years? Like, you're within that realm. But let's say you're someone who sat down and you wanted to, end up with 3 million in super by the time you're 60. And you figured out that based on the current trajectory, it's only going to be 1.2 million in super. Well, then in that case, I think it's like, oh, well, hell yeah, put in more stuff. You might as well, because you're not going to have enough anyway. And putting it in later is just going to get you less tax benefits if you have to contribute it non-concessionally. And if you're just so far away from your target, you might as well get some benefit and start it early. But I think once you're kind of like close-ish or within the ballpark of, say, 50%, you can kind of sit on it. And that's the cool thing about super contributions too, is they do stack up and you can just sit on it for a few years and see what happens because life changes and stuff. So in summary, Dave, I think it is a good thing if you think it's really evident, obviously if you don't need the capital at all in the short term, but if you think it's really evident that you're probably going to have to put a ton of money into super anyway, or ton is a bit dramatic, but chunks of money in nearly certainly later, might as well do it now.
Yeah, I see the point there. I suppose the only potential issue I have with that is you can make these forecasts now, but as you just said, life changes. So you could get 5-7 years down the road and you're like, you were super happy before with your career trajectory and with everything you were doing and you were planning to, super was the perfect part of your plan for your long-term goals. And then you get to the point you're like 5-7 years later, you're like, you know what? More than anything, I would rather just I want to take a step back. I want to have a paid off home as soon as possible so I can then work less, or I'd rather have, accessible investment so I can just kind of take my foot off the gas sooner. And so your plans might change. And once your plans change and the money is in super, you can't get it out, obviously. So that's my only concern, is that we like to think that life has this nice kind of progression and this predictability, but things can change quite dramatically to the point where a job that you loved or a lifestyle that you loved, or it was working a certain amount or in a certain industry or whatever, is great 1 year, and then 3 years later everything changes and your priorities change and you want to pivot really badly, and now the money, well, not 3 years, but you know what I mean, the money that you've put away in one area cannot be accessed and you can't kind of undo that decision. So I would rather pay a premium by way of higher taxes to keep access to the money, because it gives me much more optionality and flexibility for those kind of life changes and those pivots that you might want to do. Because I just find life inherently unpredictable. And so maybe I massively overvalue the certainty of having access to capital, and maybe I overvalue flexibility relative to the average person. Could be part of it too.
I don't think you do. I agree with you. I just think my take is there's certain scenarios where it doesn't matter if you change your job, or it doesn't matter if you're probably still not going to have enough. And in that case, I think it's worthwhile, because getting like if you're in the 45% tax bracket, you're earning over $190,000 a year or whatever, you're talking about a 30% return on your cash that year that you do the concessional contribution, right? It's massive. But again, to Dave's point, I think you have to be so sure that you still have so much more work to do. Or you nearly certainly do. Like the numbers I kind of gave before, it's just you're so close. And it's like, why would you accidentally put too much in? And we all kind of get this, right? Like I'm trying to think of a good analogy, but it's like if you come back from a holiday and you need to buy some food, if you like are just so certain that the food's going to get consumed, you would like just buy some anyway. If it's on special, you buy extra. But if you already have some in the cupboard and stuff's on special, you're like, I don't really want to like buy too much. Yeah, I might use it, but like, what if I don't? So you just need those levels of certainty. But I think we've covered it pretty well.
Yeah, so I think we mostly agree on that. So we didn't actually. I think that's all we've got for these little bits of financial advice that we don't fully agree with. So I think we've somewhat agreed, somewhat disagreed in little areas, but hopefully overall we've given you kind of a broader way to think about these things and maybe coming at them from slightly different angles to what you see mentioned in a lot of other places and the common advice that you will hear from most people in society, let's say.
Yeah, definitely. I think it was really interesting. I hope people listening have had, a good time. I think if you have particular takes that you think are, contrary to popular financial advice, we'd love to hear about them too. You can always reach out to Dave and I either on social, Strong Money Australia or Perla, or alternatively, you can email us at hello@aussiefirepod.com. Now, obviously, if you also have a question, either just generally or about your circumstances that you'd like to ask us, there are some forms we have in the show notes that you can find and click on to submit, and we'll try and integrate them into the podcast if we can. Otherwise, it's been a pleasure again. Hope you've enjoyed listening to part 2 of this conversation, and we'll catch you next time.
Thanks for listening, guys. See you next time.
We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to perla.com to browse our resources, calculators, and community insights. Perla is an authorised representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.